recorded and send out a link later after the webinar to do replays, etc. Today, what we thought we'd do is talk a lot about risk, current trends, what we see happening in the markets, how we're guiding portfolios going forward. And so first off, welcome. Thank you for taking the time. Very interested to get everyone's feedback and questions, and please put them in again in the chat thread. Since everyone's maybe not familiar with Alpha V, we'll give you a quick one slide on who we are and what we focus on. We'll talk a lot about our current view, where we see risks, and talk a lot about risks today. There's two risk managed portfolios that are extremely popular: our high quality yield and our top 5 sector and treasury. So after risk, we'll talk about how we manage risk in our portfolio methodologies and the indexes and the portfolios that track those indexes, and we'll summarize it. So jumping ahead now. Alpha V is a quantitative research firm. We were founded on a bunch of different academically grounded type of research and principles to build these benchmarks and portfolios. And over the last decade, we've been a pioneer in quantitative risk management research, and we've worked with all kinds of leading asset managers globally. And we deliver that kind of research for a variety of different asset classes, to institutions, to wealth managers alike. And the approach is totally agnostic in what investment vehicle we research or build, whether it's a mutual fund, an SMA, a hedge fund, ETF, etc. And we've invested millions of dollars, over $15 million, in developing very advanced enterprise class software and data processing techniques. You'll see some of these underpinnings today, and that's what drives a lot of the performance and results of the different portfolios and indices. Some more background. So we're in our 11th year, heading into our 12th year, based in Israel and the U.S., multiple offices throughout. Background: myself and my partners, the other founders, have all been in the technology space and have IPO'd a past company. I mentioned the very proprietary software and data processing that we built to accomplish what you're going to see today and the results, over that last decade. There's multiple U.S. patents pending for the technology. Our first ETF we launched with a major product sponsor, achieved a 3-year 5-star Morningstar rating. In 2017, won some awards. The CFA Institute, very prestigious firm, everyone I'm sure knows, wrote a series of 4 white papers based on fundamental momentum. And we're going to talk a lot about fundamental momentum because risks at the end of the day all turn into fundamentals, and there's acceleration and deceleration that happens in the fundamentals of firms. Now, in 2018, American Century launched Quint, is the ticker, QINT, currently at about $225 million of AUM. That's an international ex-US type portfolio. You can also go on our website, see the RIA channel that recognized us for this kind of research innovation that we focus on. And last year, 3 of our indexes or portfolios were in the top 10 out of 600 strategies on the SmartX TAMP platform. In 2020, SIBO and Alpha V also did some integration, and we do calc and dissemination of our portfolios. And in fact, you can look up, there's now 5 different tickers, and you can look on CBOE for that. Now, Morningstar has several of our portfolios listed. All 5 will be on there. You can see 3 of the Morningstar IDs right here. We use, again, our work isn't just domestic, it's also global, and we've licensed data recently from Chi-X for some of our global work. If you have a need or interested, some of these portfolios can also be invested in directly through ISINs for credit investors or global investors. And you can contact us for more details. And of course, performance has been audited, and one of our leading ones that we're going to talk about today which is the risk managed top 5 sector. So that's enough about Alpha V. Let's talk about the current market risk, where things are at. So with 99% of all the companies having reported their results, and if we look at kind of the results and the beat rates relative in going into kind of Q2 and where we see everything now, that things are quite positive. So it does seem good. The trends are good. Things continue to hold. The current quarter, next quarter, all still seem to be a positive from an earnings standpoint. But it's more than just earnings, of course. When we look, maybe take it up a step higher, and we look at other things that we see positive, things that are maybe on target, and then worsening trends on the better or higher than expected home prices, manufacturing index, construction spending, jobless claims, all positive. The trade deficit also down. Earning rates slightly up. Unemployment, which is good, because some of these also feed into concerns about inflation. So right now everything's positive. The employment rate also doing okay and on target. Factory orders and the true unemployment rate is essentially flat, but I believe will continue to trend down. We're going to talk about employment in a minute in more depth. However, on the worst side, home sales down, but that's kind of a seasonal cyclical thing. As we come out of summer, that should improve. The purchasing manager index, again, not strong, unfortunately. But again, summertime might have some of the some impacts to that. And a number of these, I'm not going to go through them one by one. In total, when I kind of look at that trend, am I worried for the next quarter? No, I'm not worried for the next quarter. I think these are all reasonable. None of them are extremely off. They're all historically in line. Now, let's talk a lot about employment. Though we have a lot of positive trends, the things that are worse or weakening aren't huge concerns. And I'm sorry that the chart's a little bit hard to read, so I'll help follow it. Just it's really looking at the three colors. On the pink line is the unemployment rate, so it's trending and continuing to trend down. And with the recent change in benefits being removed and that stimulus now coming out, that will probably continue to decline, the pink line. Now, when we look at the blue line, the underemployment rate also continuing to decline, and great to see the crossover with the green line, which is the participation rate. Now, the participation rate continues to be disappointing. This we need to see get back to pre-pandemic levels. Though it is trending up, it's trending very slowly up and moving too slowly for our liking. Now, again, we look at a lot of trends, and the way we manage is based on trends and the acceleration and deceleration of not just markets but sectors. Now, let's kind of take another step back and say, well, where do we see the view in Q2? The status, this was as of the very top of September, where we look at last year. We ended the year, and what a year! But numbers were up, and so far this year, continuing a strong positives across the board. However, when we think about it, and I'm sure everyone on the call today feels it, is a pullback likely, and what is the possibility? And is it a concern? So, yeah, I know, and I certainly have that feeling. And though we are systematic and disciplined, none of us can not have our opinions and our feelings. So when I continue to look at the data, and I go back to, again, 1950 here, and let me help. In blue is the past 20 years, how September's performed. Tend to be negative, as we all know. In the past 10 years is orange, and a post-election year is in gray. So I really liked looking at this chart. So September certainly is a concern. But maybe another way to look at it is when I look at that 7 months in a row, we've been on a win streak. And if I say how many, August 2021, where, we have this win streak right now. And where will we end? Will we be an 8, 9, 10, 11th month? It's happened, and it certainly could happen. And we're heading into October, November, December, typically strong. You add all these factors up, I just say the yellow light is flashing, right? It's caution. If there's a pullback up to 10%, wouldn't be a particular surprise. So being nervous, I think, is normal and natural and warranted. Do I pull out of equities? Absolutely not. Do I maybe shift allocations and exposures coming into next quarter? Certainly possible. And we're going to talk about that coming up and where our view is. Now, that's just one part of it. And what are the headwinds as we look to the future? So we have a jobs report coming up. We have the Fed meeting, of course, at the end of the month. And when we look at valuations, when we do our calculations, they're high. They're actually quite rich. Is it frothy? No, not frothy for the measures, the way we look at it. But is it a yellow light? Yes, it's a yellow light on the valuation part. Now, we have, of course, the Delta variant, the big unknown, hard to control. Schools are now opening up. We have flu season also coming up. So there's headwinds, reasons to be concerned. Inflation is a worry. However, when we look at the output to demand gap, that's tending to close. So I'm less concerned about inflation. We have the debt ceiling. And honestly, that gravity of that win streak also. So pullbacks, a 10% pullback certainly seems like I have this just gut feeling it might happen. And if it's not Q4, Q1. Now, when we continue to look, because one part is that overall market, if the whole market starts to decline. But then you have this other component that we're big believers in, is the sector piece and looking at the fundamentals and which sectors are going to accelerate, which sectors are going to decelerate. And I like to remind everyone about this part because investing across the board leaves money on the table. There's some alpha that gets lost. There's also some beta protection, the way we look at things. So in risk categories, there are certain sectors that, of course, cyclical, real estate, financials, and industrials, classical defensive sectors. But if we compare, classic example, looking at the sectors more likely to accelerate last year, and last year was a great year for people that followed our research. You can clearly see which sectors heavily outperformed, which sectors a lot of problems in. So I don't want to dwell on the past as much, but looking at those top 5 sectors this year, certainly even with an uneven opening, certainly provided a lot of opportunities. So having risk management in parallel with trying to find the sectors that are outperforming is an approach, and certainly has proven to be a very powerful approach for long-term alpha generation. Now, the way we look at it, and those that are familiar with our top 5 sector portfolio, the way we look at it is there's several overlays or lenses is the way I prefer to think about it. So we look at the market, and when the whole market declines, even the good companies are going to decline. So and the good sectors or the sectors that are going to outperform will decline. So we want to get a balance here and get a read. And we have something we call the Alpha V market indicator. My colleague, Ayal Bahari, our Chief Technology Officer, is going to go into some more depth. And that smart indicator looks at the entire market. We're going to aggregate over 1,200 companies, do a temperature check every 2 weeks of the market, and then we're going to decide how exposed to equities do I want to be, how exposed to treasuries do I want to be. Could I be 0 in one, 100% in the other? Yes. Could I be in some blend? The answer is absolutely. And that's the majority of the time we're in some blend, but every 90 days we're going to do that allocation. On the sector side, when a sector goes out of favor, like we just saw, that can really drag down performance. So we want to look, and we have a sector indicator, and we want to look for those 5 sectors that are more likely to accelerate and tilt towards those, which is the alpha part. The beta part, I guess, is slash a beta part to this is avoiding the ones that are going to decelerate. And then finally, we'll look to fundamental factors, our models that look for, once we know which sectors we want to be in, we want to then have unique models for each of those sectors and try and find the outperformance. So I'm going to hold up right there and switch over to, again, Eyal Bahari, and let him carry forward.
Thanks, Lee. Could you still present?
Yeah.
Slides? Yeah. So looking at those 3 risk levels, I want to go into the actual data that to show some of how those risk levels are managed. Lee, can you bring the presentation up? Thanks.
Yep. You can't see it now?
Nope.
Oh, hold on. Sorry, guys. Technology challenge right now. Hold on. Make sure what's. Let me bring up the screen. Sorry. Here. And one more time. Have the screen.
Okay. Okay, great. Thanks. So looking at the market risk, if you look at the first chart there at the top, S&P 500 total return, monthly returns. As Lee mentioned, when the market goes down, everything goes down. So what we're trying to do with this risk level is to mitigate volatility, to reduce standard deviation by coming out of the market when we identify these times. The way they're identified is based on what we call fundamental momentum. We look at a large number of stocks and see how their fundamentals change over time, that trend. And when you look at the chart at the bottom here on this slide, you can see the difference between the S&P 500 performance and the S&P 500 that's controlled by switching in and out of the S&P 500 at different percentages. So the basic idea of the market risk control is to jump out of the market when we're identifying, when we notice that the market's going to go down, so to improve standard deviation. The next level of risk management that we use is the sector risk control. Now, without talking about the top 5 strategy, which we'll talk about later, the technology behind sector risk control looks at all the sectors, and using the same fundamental momentum technology, we're trying to identify which are the sectors that are strongest to accelerate, that are most likely to accelerate, which are the ones most likely to decelerate based on that data. And over time, when you look at those indicators, we can determine, or we've seen the performance when we're shifting, overweighting to the strongest sectors, underweighting to the weakest sectors, and you see some of the data behind that. That's the idea of the sector management, the risk management for sector control. The last risk level that we manage is the selection risk, and that means once we've determined what percentage of equity we want to be in based on the market risk, we then determine which sectors or how we want to overweight or underweight the sectors using the sector management. Now, when we're defining or when we're deciding which stocks to select from those sectors that we've chosen, we use a multi-sector, multi-factor model where we're selecting factors for every sector based on that sector's performance and research that we've done. And this is one example of how the industrial sector behaved in a number of years. And also, if you look at the chart at the bottom, you can see what our tercile analysis shows, that selecting the better stocks based on their higher grade overall gives a better performance. That's tercile 1 in the blue line versus tercile 2 or 3. So that's how those 3 risk levels are managed in the system using the data. Thanks, Lee.
Well, thanks very much. Okay, so let's talk about implementation. So how can we take trend following? How do we take risk lenses into account? How do we overlay the work that we do every day in looking at risk and all the different types of risks that we covered so far? So when we look at one of our research strategies, it's called the Top 5 Sector Equity and Treasury Bond Index. We applied these 3 different risk lenses to the portfolio. And when we look at market risk, the first thing is, as I mentioned, we can aggregate using fundamental momentum a large number of companies, more than 1,200 companies. Every 2 weeks, we'll do a temperature check of that market, of the market, and then we need to make a decision every 90 days, 4 times a year, how much to allocate between equities and treasuries. And it can vary all the way from 100% to 0%, either way. More than 90% of or about 90% of the time, it's somewhere in some blend. Now, what do I mean by that? So there's a little table here I like to show, and this is the actual table that we use. So when we see that there's a lot of value, great opportunities to be in equities, and the reported quality of those companies is strong, we want to be 100% in equities. That's kind of the annotation here, E100, fixed income 0. Let's go to the other extreme. When we see the market is frothy, it's gotten very pricey, and the reported quality has declined, earnings to you name it, quality is down, we're going to be in no equities and all in fixed income. Now, those are the extreme positions. We could be 60-40, 40-60, 90-10, 80-20, etc. And that tends to be the case. The majority of the time, I think it's technically about 84% of the time, approximately, we're in some blend of these other positions. And every 90 days, we're going to go through our methodology, our discipline, and go through the models. And one of these will be selected, those positions. But that's just the market piece. If we know we're going to be in equities, we then first, before anything, have to decide what are the right 5 sectors. Because as we've spoken about with the actual data over the last couple of years, and this is proven out for many, many years, if we can find the right 5 sectors that are more likely to accelerate and stay away from the ones more likely to decelerate, we can generate alpha from that process year after year, and again, have lower standard deviation. And that's kind of the yin and the yang. I don't know. There's a lot of analogies. The needle that we have to thread between alpha generation and what I call active standard deviation, so below the benchmark standard deviation. And that's what we're attempting to do with this kind of portfolio index. So here we'll use our signal to look for the 5 sectors more likely to accelerate. And then finally, once we've identified those 5 sectors, we're going to go through our process. For each sector, we're going to look at only U.S. equities. They have to have more than a $5 billion market capitalization. We'll apply fundamental factors and valuation models and selection models that are unique for that exact sector. We'll, of course, check the liquidity to make sure there's no problem. Then we're going to weight them equally. And this is the process that we'll do for the rebalance and reconstitution every quarter. Now, that's the equity model. We have a second strategy that a lot of registered investment advisors asked us for. Now, this first one's kind of the big brother. You can see what goes into, or maybe have a feel for the kind of research that we accomplish every 90 days. And in a moment, you'll see the kind of performance, live performance, historical performance that's done, which platforms that's available on, etc. A lot of wealth managers, though, asked us, instead of picking the 50 names, could we just have stopped with just these two sectors? And instead of the 50 names, just give us the 5 ETFs. And you're giving up selection alpha by doing that, but that's kind of, listening to the market, and what people want is, and everyone is now understands how the market piece works. We also have a second portfolio that's just ETFs. It'll have one component for treasuries and another 5 components for the sector ETFs. And that's how it works. So after we identify the market risk, just like we talked about, we know our 5 sectors more likely to accelerate. We will then select which of the 5 iShare ETFs we want to use. So given that background, let's go into a little more depth, and Eyal will walk us through these portfolios, and how they've performed over time. And maybe before we jump right into that, let me bring up one more item just to kind of get it started. And let me switch screens for a moment on everyone and take a look at one of the TAM platforms I happen to like, SmartX. I like their format and how they do it. We're on a number of these. It's just my preference. And the top 5 sector, when we quickly look at this one, the equity piece, we can see, general statistics, how it's done year to date. It's pulled back a little bit, and this is the risk management going on, keeping the standard deviation lower while still putting up black numbers every month. If I quickly look for a minute on the live performance, how it's done. So again, risk management in action. We do have some red numbers, but trying to put up as many black numbers, of course, as possible, and how we've performed over recent years. When I compare that, if everyone just remembers these kind of numbers for year-to-date numbers, and we spoke about this kind of the big brother portfolio, the equity portfolio, and then the sister portfolio is our ETF one. Not that it's done bad, it certainly hasn't done bad. And standard deviation, again, we're balancing black numbers versus active standard deviation. So here are the 3 numbers, recent 3 numbers there. Again, what's the delta? Why is this one lower? We don't have the selection alpha. We're not picking the 50 winning names from hopefully the 5, accelerating sectors. That's the delta between those two. So 11, 40, 30 versus currently 15, 51, and 32. So having said that, let me turn it over to Eyal, and you can bring us through the rest of the way.
Thanks, Lee. Let me share my screen. So talking about the top 5 sector equity and treasury bonds, what you're looking at now, this is our platform, 100% our development. And this is where the index has been developed, analyzed, and I want to show you some of the capabilities of the platform and how this index is managed. So when we're looking at this strategy, and we've talked about 3 risk levels, and this is how you can see how they're implemented. So the top risk level, the market risk, is managed using this 9-cell matrix. And the quality y-axis, the value is the x-axis. Those 2 axes are actually the market indicators that we spoke of before that measure the market both in quality, which is fundamental momentum, and also in value, where how cheap or expensive the market is. Depending on those indicators, we will be in one of those 9-cell matrix, one of the cells in this 9-cell matrix. If we're at good quality and good value, then we'll be at the top right-hand corner, and we'll be 100% in equity. That's at the risk level, at the market risk level. On the adverse side, if we're bad value, we're a low value indicator and a low quality indicator, meaning earnings are bad, value means market is very expensive, will be 100% in bond in this index. So that's the market risk. If we look inside into one of those strategies cells, we can then talk about the sector risk.
By the way, it's important to note, why is one cell colored in yellow? If we were going to invest today and launch the portfolio today or as of yesterday's close, that would be our allocation. We would be 20% in treasuries, 80% in equities as of right now. Sorry, Al.
Thanks. Yep. So the sector risk, as I mentioned before, we're looking at the sector indicators and determining which are the strongest sectors, the most likely to accelerate, which are the weakest. And in this index, we're picking only 5 of them. So we're not overweighting or underweighting. We're selecting the top 5 sectors, and the weights for each of those sectors are determined by their weights in the benchmark. So the strongest or the largest weighted sectors in the S&P 500 will remain the largest if they're picked, and the rest of the sectors, those 5 sectors, will be weighted relatively to their market, to their weights in the benchmark. That's how we determine which sectors and how much weight they get. The third level is going to be the stock selection, and as we've discussed before, when we're looking at each sector, we've got a separate model for that sector that we've researched using the tools that we've developed in our system, and we've got a factor model that selects the top stocks out of every sector. So we're looking at the multi-sector, multi-factor model. For instance, for industrials, we're picking minimum market cap of 5 billion, only US stocks, and we're measuring based on these factors. If I switch over to tech, we'll see a different set of factors. So that's how we do the stock selection. And all that is combined in our platform, and we're running this model. It's updated on a daily basis. We've got history running back to 2002, and we've analyzed this model. If we want to look at, let's say, the last couple of years, 20 to 21, see how that performed in the year 20, I can switch on the strategies overlay, and that shows you the market risk. That shows you how we've switched from being 100% bond at the beginning of 2020 and moving to 100% equity, and then back to 100% bond. This is in the Q1, Q2, Q3, and that continues. These switches continue to happen based on those value and quality market indicators that we discussed. We're currently at 80-20, and as we mentioned, if we were to rebalance today, that's where we'll be also. What will be at the end of the month, we don't know yet, but Lee showed all of the indicators showing that in terms of quality, we'll probably still be strong. But that determines that we'll still see how that works out at the end of the month.
Great.
So that's
thanks very much, Eyal.
That's how we implement the strategy. Go ahead, Lee.
Okay, take the screen back for a moment. Okay, hold on, guys. Let's get back to here. Appreciate that. Can everyone see my screen now?
No.
No, didn't come back yet. Hold on. And here we go. Better?
Yes.
Okay, so hopefully we've gone through kind of the current view, what we see coming up on the horizon, how we look at signals, how we think about managing risk and performing the research, how we apply some of our signals that we've developed using this kind of methodology and the mindset. You can see it's very risk focused. We're very disciplined. It's I think an extremely robust approach to the portfolio construction. For everyone in the audience that wants to follow along, these are available in a couple of places. The indices you can see live at this link if you go on cboe.com. The tickers are also available. You can put them up in Bloomberg or FactSet or Google or what have you. Or if you're a Morningstar user, we have the Star IDs listed. People that want to purchase ISIN notes, they're kind of like structured notes. You can buy the portfolios directly and globally. If also the verification of the performance is available directly on cboe.com. There's a link to the performance verification. We want to talk a little bit about quality yield as well. And for looking at the quality yield, let me switch screens because we want to talk about income and fixed income for a moment. So the Alpha V has a set of portfolio. We use a little bit of a different approach on our quality yield, and it's done very, very well. You can, of course, go on CBOE and look at the performance over time. This approach for a quality yield product is rebalanced and rebalanced every month. We look in this approach, and by the way, maybe we should, hold on, look at it live right here. I'll pull up our quality yield. And you can see the overall statistics, annualized average of 6%. Year to date, it's 3.82%. And the standard deviation, I'd like to point out, it's sub 5%, so it's like an individual bond. Performance-wise, over the past, wish it was going to be another year of double digits, as we had in past years. But, you know, even with our best efforts, we're still, I don't see that likely. But we have 3 more months to complete, but doing okay. Now, how is this actually achieved? Let me jump back. The philosophy is we look at medium duration US Treasuries. Again, it's a high yield strategy built from US Treasuries and represented through IEF, the tracking index. We use preferred shares. Again, the index there is hybrid preferred shares, PFF. And then the covered call on the NASDAQ 100, QYLD. Now, what we do is each month we use a dynamic formula. And Eyal, I don't know if you were going to talk, or were you going to cover more of this approach, or should I continue?
Yeah, go ahead.
So this dynamic approach each month allows us to look at really the momentum. If flows and momentum go more towards treasuries, more towards the covered call, more towards preferred, that's how we're going to tilt the portfolio. We are always invested in all three, or significantly invested in all in 2 of the 3. 1 may be less, but you're always in all 3. It's just we're varying the percentages each month based on this dynamic formula, momentum-based approach, and that's the approach that built or delivered these results for the subscriber. Again, the risk approach is very different. It's a much more conservative approach, as you can tell from the overview that I showed. To achieve this kind of flat line with just 3 positions and get these kind of returns has been quite attractive. A lot of managers have told me they use this in portfolios where they have clients that need to draw, say, 5% reliably over time. They don't want to touch the principal at that point. So this one tends to be a good tool for their toolkit for that approach. So that's a little bit about how this portfolio is constructed, how the tactical tilts work between treasuries, preferreds, and the covered call. And that's our quality yield strategy. You can contact any of these firms to invest directly in these and others. Of course, go on alphav.com. We also offer direct indexing as well. And so we covered, hopefully everyone in the audience knows a little bit more about Alpha V, what's what we see is what's beyond the horizon, how we use and manage our risk and our research and the portfolios. And that's the summary. Please, other questions? We'd love to know what challenges you're facing. What are you struggling with? What research we can provide? And I'll just leave our disclosure statement up for another couple of minutes. Sorry we went a little bit over. We tried to keep it to a half an hour, but there's a lot to cover this quarter. And also, I'd love to hear if you found this kind of information update useful, and if there's other formats or ways. All suggestions are really great. So again, thank you everyone for your time. We'll conclude now, and you can reach out to us again on alphav.com, shoot us an email, etc. Thank you everyone very much for your time.